I've traded gold and silver for 25 years. And in that time, there have only been 3 moments where the market told the truth before the headlines did. This is one of them. Right now, a signal is forming in the charts that has appeared only a handful of times in the last half-century. Each time it appeared before, a multi-year wealth shift followed. Some investors rated early and positioned themselves accordingly. Others waited for confirmation and paid the price of hesitation. The question is no longer if this shift happens. It's whether you'll be positioned before it does or after. Because what happens next in gold and silver may not just be a market movement. It may be the beginning of the next great transfer of wealth. And in that time, there have only been 3 moments where the market told the truth before the headlines did. This is one of them. Right now, a signal is forming in the charts that has appeared only a handful of times in the last half-century. Each time it appeared before, a multi-year wealth shift followed. Some investors read it early and positioned themselves accordingly. Others waited for confirmation and paid the price of hesitation. The question is no longer if this shift happens. It's whether you'll be positioned before it does or after. Because what happens next in gold and silver may not just be a market movement. It may be the beginning of the next great transfer of wealth. Welcome back to Precious Metals Intelligence, the channel dedicated to serious, data-driven analysis for those who prefer to understand markets before the crowd does, not after. For 25 years, one trader has watched gold and silver move through cycle after cycle. He has seen booms, he has seen crashes, he has seen moments when the crowd panicked and moments when the crowd celebrated too soon, and through all of it, he learned something that most casual investors never notice. Gold and silver do not move randomly, they follow patterns. These patterns repeat across decades, almost like a heartbeat. Once someone learns to recognize this heartbeat, the market stops looking chaotic. It starts looking predictable. This is the foundation of everything that follows in this analysis. To understand where gold and silver are headed next, it helps to look back at history. Over the past 50 years, precious metals have experienced only a small handful of truly major breakouts. These are not ordinary price increases. They are the rare moments when gold and silver surge to levels that redefine the market for years afterward. But here's the part most people miss. After every one of these major breakouts, a sharp correction follows. Prices pull back. Fear returns. Investors who bought near the top begin to doubt themselves. Headlines declare that the bull market is over. And yet, every single time, this correction has followed a similar shape. It does not last forever. It has a beginning, a middle, and an end. Once someone studies these corrections side by side, lining them up on the same scale, the resemblance becomes hard to ignore. History does not repeat perfectly, but it rhymes closely enough to be useful. This matters right now because gold and silver are currently living through one of these correction phases. Prices have pulled back from recent highs. Sentiment has cooled. Some investors have grown impatient. Others have quietly walked away, assuming the opportunity has passed. But according to this pattern, walking away now may be the biggest mistake an investor can make. The real question is not whether a rebound is coming. Based on the historical pattern, a strong rebound is expected. The real question is timing. Has the bottom already been reached, or is there still one more leg down before the true turning point arrives? This is the tension that defines the entire outlook for gold and silver right now. It is not a question of direction. It is a question of patience. Think of it like a coiled spring. The longer prices stay compressed, the more force builds beneath the surface. Eventually, that pressure has to release. The only uncertainty is exactly when that release begins and how sharp it will be once it starts. For business professionals and serious investors, this distinction is critical. It separates reactive decision-making from strategic decision-making. A reactive investor waits for the headlines to confirm a trend, then rushes in after much of the move has already happened. A strategic investor studies the pattern early, prepares for multiple outcomes, and positions before the certainty arrives. This is not about predicting the future with perfect accuracy. No analyst, no matter how experienced, can promise that. It is about understanding probability. It is about recognizing that history has shown a repeating structure, and that structure strongly favors what comes next for precious metals. There is also a deeper layer to this story. It is not only about charts and price levels. It is about what these patterns represent in the real economy. Gold and silver have historically served as a signal. When capital begins shifting into precious metals in a meaningful way, it often reflects growing uncertainty about paper assets, currencies, or the broader financial system. In other words, this is not just a story about metal prices rising or falling. It is a story about where large pools of capital choose to move when confidence in traditional markets begins to weaken. This raises the central framework that will guide the rest of this analysis. There are 2 possible paths forward from here. One path is calmer and more gradual. The other involves one final shakeout before the real move begins. Both paths lead to the same eventual outcome. But the experience of living through each one is very different, and understanding both is essential for anyone trying to make sound decisions in the months ahead. The next section will break down exactly what these two paths look like and what signals separate one from the other. Every major turning point in the market comes down to a choice between patience and speed. Right now, gold and silver stand at exactly this kind of moment. There are two ways this next chapter could unfold, and understanding both is essential for anyone trying to make smart decisions with their money. The first path is the calmer one. In this scenario, the correction that gold and silver have already gone through is enough. The low point is already formed. From here, prices slowly and steadily climb back up. There's no dramatic crash, no final scare, just a gradual healthy recovery that builds over several months. This kind of recovery tends to reward those who stayed calm and did not panic during the pullback. It rewards patience over prediction. Investors who held their positions or who added to them during the fear benefit the most from this scenario. It is less exciting, but it is often the more common outcome historically. The second path is more dramatic. In this scenario, the current rebound in prices does not hold. Buyers step in for a while, prices rise a little, and then momentum fails. Prices fall again, dipping below the recent low. This creates what analysts often call a false bottom. It looks like the end, but it is not quite the real one. This second dip can be unsettling. It often shakes out investors who were already nervous. People who bought near the top may sell in frustration, convinced that the opportunity has failed. This is precisely why this scenario tends to set up an even stronger rebound afterward. When the weakest hands leave the market, it clears the way for a sharper, more powerful move upward once the true bottom is confirmed. So which path is more likely? This is where a major external factor becomes important: the actions of central banks, particularly decisions around interest rates. If a central bank moves to raise interest rates in the near future, it could act as the very catalyst that triggers this second, deeper dip. Higher interest rates often pressure precious metals in the short term, since they increase the appeal of holding cash or bonds instead. But historically, this kind of pressure has tended to mark the final stage of a correction, not the beginning of a larger decline. In other words, even a short-term negative shock from a rate hike could end up being the exact moment that confirms the true low is in place. What looks like bad news in the moment can end up being the final test before the larger rally begins. This is a difficult concept for many investors to accept. It feels counterintuitive to view a price drop as a positive signal. But for those who study these cycles closely, sharp final declines have often marked turning points rather than the start of deeper collapses. For professionals and serious investors, the key lesson here is not to try to predict exactly which path will happen. It is to prepare for both. This means avoiding extreme positions in either direction. It means not assuming the bottom is guaranteed to be in, while also not assuming a much larger crash is coming. Instead, it means building a strategy that can perform reasonably well whether the recovery is smooth or whether one more shakeout happens first. This kind of balanced thinking separates strategic investors from emotional ones. Emotional investors chase certainty. They want someone to tell them exactly what will happen next, so they can feel safe making a decision. Strategic investors accept that certainty does not exist. They focus instead on positioning wisely for a range of likely outcomes. This is especially important for those thinking beyond the next few weeks or months. The short-term path, whichever one occurs, is really just noise compared to the larger, multi-year story unfolding underneath it. And that larger story is where the real opportunity lies. To understand why, it becomes necessary to look at what makes this current cycle fundamentally different from previous major peaks in precious metals history. That comparison reveals something important, and it is the focus of the next section. To understand where gold and silver are truly headed, it helps to ask a different kind of question. Instead of asking what looks similar to the past, it is more useful to ask what looks different. And when this current cycle is compared honestly to previous major peaks in precious metals, several important differences appear. In the past, before every major collapse in gold and silver, there was a clear warning sign. Large amounts of money would rush out of stocks and into precious metals over a period of several years. This rush would grow more and more extreme until it reached a breaking point. Once that breaking point was reached, the bubble would burst and prices would fall hard. This pattern happened in the early 1970s. It happened again at the end of that decade. Each time, the shift of money from stocks into metals lasted for years, not months, and it grew increasingly aggressive right before the peak. Now compare that to what has happened recently. The shift of capital from stocks into precious metals over the past few years has been much smaller and much shorter. It has not shown the same extreme, prolonged rush that came before previous major peaks. This is an important clue. It suggests that the market is not standing at the edge of a similar collapse. There is another difference worth noting. Before past major declines, prices would often show signs of exhaustion, charts would flatten out, momentum would fade slowly over time, like a runner who is tired but still moving forward out of habit. This current correction does not show that same kind of exhaustion pattern. Instead, it looks more like a normal, healthy pullback within a longer uptrend. Together, these differences point to an important conclusion. This is not the ending stage of a long bull market. It looks much more like an early or middle stage. That distinction changes everything about how investors should think about the months and years ahead. This leads to a bigger, more important idea. History shows that a true, long-lasting bull market in gold and silver cannot happen quietly. It requires a specific condition to be present at the same time. That condition is trouble in the stock market. Whenever precious metals have entered a truly major multi-year rally, it has coincided with a period where stocks were struggling. As confidence in the stock market weakens, investors look for alternatives. Gold and silver have historically been one of the main places that capital flows toward during these periods of doubt. This is not simply a coincidence. It reflects something deeper about how large investors and institutions behave. When traditional markets feel unstable or overvalued, money does not disappear. It moves. And historically, a meaningful portion of it has moved into hard assets like gold and silver. Right now, this specific condition has not yet fully appeared. The stock market has not yet entered the kind of prolonged difficult period that has historically accompanied the biggest moves in precious metals. This might sound like a reason for caution, but it should actually be viewed the opposite way. The absence of this condition does not mean the opportunity has passed. It means the larger move has not truly begun yet. In other words, the bigger story may still be ahead, not behind. This is where patience becomes a genuine advantage rather than just a comforting phrase. Investors who understand this distinction have the chance to position themselves before this larger shift takes place, rather than reacting once it becomes obvious to everyone else. For business-minded viewers, this idea should feel familiar. It resembles the difference between entering a market early, while it is still overlooked, versus entering after it has already become popular and expensive. Early positioning, when supported by sound reasoning, has historically produced better long-term outcomes than late reaction. None of this guarantees a specific outcome. Markets always carry uncertainty. But the historical evidence does support a clear and important point. This cycle does not resemble the ending of a bull market. It resembles the earlier chapters of one. If that is true, then the more important question is not whether change is coming. It is how large that change could eventually become and what that could mean for the years ahead. That is the focus of the next section. If the reasoning so far is correct, then something larger is forming beneath the surface of the market. This is not just a short-term bounce in gold and silver prices. It may be the early stage of a much bigger shift in where wealth flows over the next several years. To understand what this could look like, it helps to imagine the next 2 to 3 years playing out in a specific way. Stocks enter a difficult, extended period. Growth slows, confidence weakens. Investors who once felt certain about their portfolios begin to feel uneasy. At the very same time, gold and silver begin to strengthen, not because of hype, but because capital is quietly searching for somewhere safer to go. This kind of shift rarely announces itself clearly at the start. It tends to begin slowly. Prices creep higher. Most people barely notice. Financial news continues to focus on other topics. Then, over time, the move builds momentum. What began as a quiet trend turns into a much faster, more noticeable one. By the time it becomes obvious to the general public, a large part of the opportunity has already passed. This is why the current period matters so much. It sits before the loud, obvious stage. It sits in the quiet stage where the setup is forming but has not yet been widely recognized. For business professionals and serious investors watching this unfold, it is important to be clear about what this means and what it does not mean. This is not a promise of guaranteed profits. No historical pattern can offer that. Markets are influenced by many forces, and surprises are always possible. What this pattern does offer is a reasonable, historically supported case for paying close attention right now, rather than waiting for confirmation that may only arrive after much of the move has already happened. There's another important point worth making here. Not all exposure to gold and silver is equal. Simply owning the metal itself is one approach. But history shows that well-chosen companies operating in this sector, businesses with strong management, sound assets, and healthy finances, have the potential to perform even better than the metals themselves during a strong upward cycle. This is not about chasing the flashiest or most exciting names. It is about identifying quality. Companies with strong fundamentals tend to hold up better during uncertain periods and tend to benefit the most once conditions improve. This distinction between speculation and quality is one that separates long-term strategic investors from short-term reactive ones. It is also worth remembering that this entire outlook is built on patience, not urgency for its own sake. The two paths discussed earlier, the calm rebound and the sharper false low followed by a stronger rebound, still remain in play. Nobody can say with certainty which one will occur first. What matters more is the direction this is likely to head over the coming years, not the exact week or month it begins. For those willing to think several years ahead rather than several days ahead, this period represents something valuable. It represents a window of time where positioning can happen before the broader shift becomes common knowledge. History does not repeat in exact detail, but it often rhymes closely enough to offer real guidance. And right now, the rhyme points toward a meaningful transfer of wealth taking shape, one that rewards patience, discipline, and early awareness over hesitation. There is still one more piece of this story left to explore. It involves a specific signal, one that has appeared before major turning points in the past, and one that may already be forming right now. That signal will be the focus of the final part of this analysis,